Yo, what's good? Hey, this is going to be a dope video because I want to talk a little bit about Silicon Valley Bank, why we got banks collapsing. Are we going to see more banks collapse in the future? And I'm going to just explain and break down what happened. And, is it something that you should panic about? Look at this face. This is the face of a non-panicker over here. So I'm thinking most people are probably going to be non-panickers as it relates to this particular matter. Now, before we dive in, I am a licensed attorney. I'm Marcus. You're the channel, The Debt Free Dad. Finances, financial opinions, takes, topics, attorney reactions. Now, before I dive in on what happened with Signature Bank, and what happened with Silicon Valley Bank, I want to explain a little bit about just kind of my area of expertise. Banking regulations is probably something I looked at in the past 3.5 years more than anything ever in the legal field that I probably should have been concerned with. So I'm not going to say I'm an expert with banking regulation, but I am very familiar with banking regulations, investigations, how banking industries collapse, how banks falter, and all of that stuff. So I have some familiarity in this subject matter area. So I just wanted to talk about what happened. Should we panic? What is going on? Are we going to have to flip the bill for it? And all of that stuff. So I'm gonna try to keep this as brief as possible. Before we dive in, make sure you hit the like button, hit the subscribe button, hit that bell notification so you can get all the content. Okay, so we got to rewind a little bit. In 2008, we know that they had a housing crisis. The housing market crashed in 2008. Banks were all plummeting. Their stocks went down to nothing. You seen Bank of America, Wells Fargo. You seen the usual suspects that are probably terrible banks in my opinion, but you've seen the usual suspects. Their bank stocks went down, and the housing market, the banking market kind of collapsed. Now we know what happened. Market collapsed. It was essentially banks took a bundle of mortgages. They took 5 million mortgages and they placed risky bets on them. Are they going to default? Are they not going to default? And they kind of got in over their head. So what happened as a result of that? The Dodd-Frank Act was passed. The Dodd-Frank Act was essentially legislation that said, hold on, wait, we got to regulate these banks. We got to reel things in so that these types of collapses can't happen in the future. This isn't good for the banking industry. And so, with the Dodd-Frank Act, the most important thing in the Dodd-Frank Act that was significant in what we have going on right now is the amount of actual capital, the amount of liquidity that banks are supposed to have. I did a video where I talked about liquidity and Kanye West, how he need to get his liquidity game up because he worth a lot, but he ain't have a lot of cash on hand. But essentially, I guess the easiest way to think about it is after 2008, after 2008, I said 2008. I combined the number 8 and banks all together. Wow. Okay, after 2008, essentially, if we think of it in the easiest way to think of it is if you deposited $100 into your bank, the bank was required to keep about 20% of that of actual cash reserves on hand. What the hell did they do with the other 80%? Of course, banks did what banks do. Banks are going to bank. They loaned that other 80%, the other $80 that you had, they loaned that out, charged somebody some 25, 20, 19, whatever, some high ass interest. They made money off of it. They paid you a small percentage of those profits that they made, but that was essentially the rule. They had to keep 20% of the amount that you deposit in actual liquid cash. So in the event if you wanted some money, you can go back and get it. Now, I don't know if y'all ever tried to go to the bank to take out a substantial amount of money, but it is a pain in the you know what. I went to buy a car once and I tried to take out like $8,000. Like 2 days before I took out the maximum I could at the ATM machine, like Monday, Tuesday, Wednesday, I said, I'm just going to go in the bank and take out this remaining $8,000. It was difficult to pull out $8,000 because they were just like, huh, why you want to do that? There's all these questions. It was additional paperwork for maybe it was 11,000, but whatever it was asinine and it shouldn't have been that difficult. So in 2008, Dodd-Frank said banks had to hold 20% of the money you deposited in liquid cash so they can give people their money back. let's fast forward to former President Donald Trump. Well, Donald Trump passed a lot of tax things. They got rid of some regulations. Essentially, the banks lobbied and they paid campaign donations. And the banking industry were actually able to get them to ease up the Dodd-Frank restrictions. So now instead of banks having to hold 20% of the money you give them in actual cash, they had to hold maybe 5% or 3%, but it was a lot less. The interesting thing is the author of Dodd-Frank, who after actually drafted that legislation, was in charge of one of the banks that collapsed in New York. It's hey, two sides to each coin, right? So President Trump essentially got rid of the requirement that banks had to hold that 20% in liquid cash. And so banks have just been banking since. Now let's fast forward to Silicon Valley Bank. Silicon Valley Bank is a regional bank, hence the name Silicon Valley. It's a bank that's in that area where there's a lot of tech stuff. So you have a lot of tech startups, a lot of venture capitalists. They all put their money in that bank. So, tech startups, small companies that may deal with programming or hardware or software or what have you. Venture capitalists is just a group of guys who got a big ass pot of money to invest in small startups so they can make a big ass profit, cash out before it goes public. So this was a vast majority of the people and the types of businesses that you would see invested in Silicon Valley Bank. So you got all of these. Now, before we go any farther, you got to remember everyone's account is insured with a financial institution up to $250,000. But let's put this into context. Like 95% of the money at Silicon Valley Bank was money over that $250,000 requirement. So the vast majority of money that Silicon Valley Bank held was money that was uninsured. Let's just put that into context. And Silicon Valley Bank was the 16th largest, was the 16th largest bank in the United States. So here is how Silicon Valley Bank and the other bank in New York, this is what caused them to eventually go under. And part of it is the blame on easing restrictions with the Dodd-Frank Act and the requirement that banks keep 20% of the deposit money. The other part of it is thanks to communication, technology, and Facebook. So here's what happened. The bank said, you know what? We need to invest this money, the deposit money that people are depositing into the bank. So what did they do? They invested the money in something that was really not that risky. They invested the money in government bonds. Like, you hear a lot of people talk about, oh, I invest in treasury bonds and all this, but they did something that was really low risk. They invested their money in government bonds. But government bonds, just like stocks, they operate in interesting ways. You have some government bonds that, as inflation goes down or as the government increases the interest rate on those bonds go up. But you also have some bonds where as the government increases the interest rate, what those bonds are yielding, the interest rate goes down. So this bank invested in government bonds, which is relatively safe. But as the Fed kept raising interest rates, the value of their government bonds that they held continued to decrease. So what happened? They said, you know what? We need to sell some of these assets. We got government bonds. There's a safe investment, but because the Feds keep raising interest rates, the value of these bonds are going down. So we need to sell some of these bonds, even though we're selling them at a loss. So this bank decides to sell some of their bonds. They sell those bonds at a loss. Now, here's where it gets interesting, because now they're selling those bonds at a loss. And this is where the communications start. People say, damn, why is my bank selling their government bonds at a loss? People start saying, that doesn't look right. So people are probably thinking about moving their money out or taking their money out. You probably got some people going to get their money out. But this bank sells their bonds at a loss. The word starts to get out because of the internet, because of social media, because of email, because all these mediums of communication we have. The word gets out that this bank is selling its bonds at a loss. People start getting scared. People start getting shook. People wanting to go to this bank, and that's why you saw the long ass line of people at the bank to get their money out. But it's not over. There was nothing else. Once the word got out that they're selling these bonds at a loss, the next thing the bank decided to do was, you know what? We have to do something to raise capital. So right before the banks collapsed, they used all of their effort to try to raise billions of dollars in capital so that they can maintain their liquidity. But what happened? Well, the lawyers couldn't lawyer fast enough. When you try to raise that much capital, if you don't have non-disclosure agreements and those type of things in place, what do you think is going to get out? The first day they said, wait a minute, my bank is selling treasury bonds at a loss. That's weird. The next day, what do they hear? They hear that, wait a minute, my bank is trying to raise capital. Oh, nah, something's up. I'm going to get my money out. So you have this big ass influx of people who all ran to the bank at one time. It was a bank run. That's what they call it. It's called a bank run. Because of that situation, you had this large amount of people all online, all running to the bank to pull their money out at one time. Now, remember, when Dodd-Frank passed back in the day of 2008, banks had to keep 20% of the deposit amount in cash. But because of President Trump, they peeled back those restrictions. So when it was a line of damn people at the bank who had millions, hundreds of millions of dollars in the bank, companies, small businesses, startups, venture capital firms who had all these millions of dollars in the bank, when they all lined up to withdraw their money at the same time, you know what? The bank was asked out. The bank didn't have any money. They weren't liquid. They had, isn't that funny? But it's funny because it's kind of silly because they had no money to pay the people their money back. They could not pay the account holders, the small businesses. Like even I saw a lot of YouTubers out there. They use SD to sell things, and SD had a large percentage of its money in Silicon Valley Bank. So there was a potential for people who sell things on SD to actually not be able to get compensation. So that's kind of how it happened. Now, do I think this is an issue or something to worry about it? Like I said, this is the face of an unworried person. Let's talk about like what makes banking work. Essentially, what makes banking work is the same exact thing that what is the same exact thing as what makes our money that's not by gold work. What gives a dollar its value? It's not because they say it's a dollar. It's the confidence that the economy, that the market, that the consumers have in the value of that dollar. With banks, it works the exact same way. If banking confidence ever collapse, that'll be a terrible day for the US economy and the global economy as a whole. When Silicon Valley Bank sold those treasury bills at a loss, then word got out that they were trying to raise up all of this capital to be able to cover some of those losses. When that word got out, all the people who had money in there, they lost confidence in the bank. They ran to make the withdrawals of their money. Silicon Valley Bank had no liquidity to actually pay them. Next thing you know, now it's owned by the government. Then the same thing happened to the bank that's owned a bank that's operating out of New York, which is funny because the person who drafted the Dodd-Frank Act that required banks to be liquid to some extent actually was the person in charge of that bank, and it went under. So, hey, that's I just, that's a coincidence. I think that's, hey, that's funny to me. But essentially, they lost confidence. And the banking system only works on confidence, with the confidence that if I put my money in there, I know that when I need it, I can go in and get it out. So I don't think that this will impact most people. I don't think we're going to see. Now, we probably will see 2 or 3 more institutions fall. That wouldn't surprise me. But you're not going to see your Wells Fargo's, your Bank of America, unless they do unless they do something shady outside of this, your USAA, your Ally banks, you aren't going to see those banks go under because those banks aren't really industry heavy. Silicon Valley Bank was really tech heavy. You had, it's over there in Silicon Valley, all the tech companies, all the small startups, all the venture capitalists who invest in the tech sector. The tech sector is getting hit by, the overall stock market as a whole. But one thing that impacted it was a bank that was real tech specific. I'll use my bank. I bank with USAA. What are the likelihood that if USAA would have sold some investments and tried to raise capital, that a vast majority of the people who hold accounts there would have ran there to take their damn money out? it's slim to none because USAA actually has a business model that's not really favorable for corporations or big time companies to invest in. USAA is probably primarily made up of military members and their families. You probably got some people who started businesses and opened up accounts, but the average person isn't going to run to the bank to take their money out. The average person has less than $250,000 in their bank account, so it's all federally insured anyway. But that's why I don't anticipate this being a big deal. We may see 2 or 3 banks get kicked in the ass, but I don't think this is something that's going to strike any panic. I'm not going to go try to take all my money out the damn bank. So, that's just what's going on here. I think the other thing is, well, now that happened, how's this going to be fixed? Well, typically $250,000 would be the most that all of these people, all of these companies who had their money in the bank can get back. But because banking confidence is so important, President Biden essentially came out and said, hey, if you were an account holder, you are going to be made whole 100%, which was interesting. I thought this was the funny thing, though. Just days before this bank collapsed, you know who got bonuses? The people who got bonuses were the people who worked there. Now, I don't know how I feel about that because I'm actually not opposed because the bonuses were for their performance in 2022. So I'm not opposed to employees of a bank that collapsed still getting their bonus. I think that makes sense. But executives should not get shit. If you were an executive who sat on the board of that bank and it ultimately led to this collapse because of your poor mismanagement, I hope that they didn't get a bonus because they aren't deserving of one. The other thing that I thought about is I don't know if y'all remember when the FTX debacle happened a few months ago, and you're seeing all the old school guys who don't believe in crypto, like, oh, crypto is phony. We told y'all that this could happen. When I did a video, I said the exact same thing I'm going to say now. I don't care what the commodity is. I don't care if it's the banking industry. I don't care if it's crypto. I don't care if it's the housing market. I don't care if it's pork belly futures. Whatever it is, if it's mismanaged poorly, people are going to get kicked in the ass and lose some money. That's just kind of how it is. What's going on? I appreciate y'all tuning in. I appreciate y'all tuning in. Thank you. So, I thought that was an interesting thing to just bring up because when the FTX thing happened and crypto plummeted and all because of that, everybody said, oh, yeah, that's why crypto is phony. And, you invest in crypto if you want to, but it doesn't make a difference if it's crypto, if it's bank, if it's ran poorly, if it's poorly mismanaged, if they take risky bets with your money. I don't care what it is. It's going to be a possibility that a collapse can happen. So that's just something that you have to take into context. Now, I wanted to play this clip real quick of President Biden talking about how they're going to address it, how they're going to fix things. I'm going to dive in a little bit on that, and then I'm gonna dive in a little bit on that, and then we'll be able to close out the show. Let me see what my guy Leroy got to say. Hey man, hey, that's one. Piss coin is a real coin. So scam coin. You should have went with scam coin. It's called Super Cool Artificial Money. I told you I did a video on that, and the guy who created it at one point was a millionaire. It's a damn shame. People invest in anything. But let me play this clip real quick of President Biden talking about the government's reaction to this and what they plan on doing. I'm going to give a quick commentary on that. Let's go ahead and dive in. And uh-oh.
Speak about what's happening in Silicon Valley Bank and Signature Bank. Today, thanks to the quick action of my administration over the past few days, Americans can have confidence the banking system is safe. The deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks and the impact they could have on jobs of small businesses, banking system overall, I instructed my team to act quickly to protect these interests. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, took control of Signature Bank's assets. Treasury Secretary Yellen and the team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured, they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there, need to make payroll, pay their bills, and stay open for business. No losses will be, and I want this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. The bank is taken over by FDIC. The people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. Fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. My administration, no one is above the law. And finally, we must reduce the risks of this happening again. During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses. Look, the bottom line is this. Americans can rest assured that our banking system is safe.
All right, and see that really just kind of outlines some of the things we talked about. The banking industry, just like the stock market, is all about consumer confidence. That's why they wanted to make sure people get their money back. Isn't he turning? He looked like George Bush one. President Biden is turning into George Bush one, but for him, that was a really good presentation. But it's all about consumer confidence. That's the reason that they want to give folks their money back. I think I agree completely that all the executives should be ousted. All the executives should be fired. They actually talked about the Dodd-Frank law, which I mentioned. And you're going to see them strengthen that requirement that requires banks to maintain a certain percentage of your money. For me, I think a perfect balance would be somewhere in the 35 to 40% range. Like, hey, if I put $100 in, you should keep 35 to $40 of that in liquidity so I can go get my stuff and it won't be a problem if it's a really big deal. You know what I mean? But it's going to be interesting to see how it play out. And it's also going to be interesting to see how many other banks kind of follow that approach and fall on their damn face. I think it's going to be a handful, but I don't think it's going to be a very big deal. Nothing that, we would have to get worried about. Like I said, hey, y'all do what y'all want to do, but I'm not running to my bank to pull my few dollars I got in there out. Oh yeah, I was just looking at the CPI for housing. Over the year, housing is up 9%. Is actually kind of crazy. Yeah. Hey, man, just you ain't lose nothing until you sell, bro. So don't even trip. You ain't lose anything until you decide to sell at a loss. And if you were gonna sell, you probably should have did it before December 31st, so you could use those losses to offset your taxes. But well, whatever, just hold it. It'll probably spin back around. But yeah, that's kind of the game plan. That's what's going on. I think it's very smart. But that's when we talk about the Dodd Frank Act and the requirements that bank keep a certain amount of liquidity. This is I just want y'all to understand how politicians think, okay, or how they don't think, however you want to look at it. When things are going bad, everybody says we want regulation. Let's regulate. I don't care what it is. Crypto, housing market. Let's regulate. So when things are going bad, everyone wants to regulate. When things turn around and go good, what do they want to do? We want to deregulate, get rid of the regulations, let the market market. And so when Dodd-Frank was passed, Democrats were a big proponent of it. But in 2016, 2017, I think 2017, when President Trump wanted to peel back those Dodd-Frank protections, like 17 Democrats voted in favor of it. Because why do you think they voted in favor of it? Because banks got big ass political action committees who donate a lot of money, and they was like, yes boss, we'll do what you say. So they were on board with getting the regulations out of there. At the end of the day, I guess the bottom line and the takeaway from this was 18. Okay, see, I appreciate that. But I think the bottom line takeaway from this is, hey, y'all keep doing what y'all doing, because hey, and long story short, there's a strong possibility that you're running your household finances a lot better than the government. A lot better than the government. But things are going to happen. Don't let the fear from those things make you make a rash decision and react too fast. Sometimes you got to just stand and look back and say, okay, Signature Valley Bank, nah, that ain't going to impact me. So you got to just kind of be objective, look back, find out what's going on, and don't move too fast. Because if you move too fast and react off of emotion, that's a lot of times how you end up getting your head knocked up off your shoulders. So you definitely want to avoid that. Oh wow. Yeah, yeah. That's it. I wanted to give this really quick video, just explaining what happened, why you shouldn't worry about it. Like I said, I put a lot of bank CEOs in jail, so I'm pretty familiar with banks, regulatory matters, and where there are gaps in the process with financial institutions. And the biggest gap is greed. Greed is always the biggest gap for any financial commodity or any financial institution going under. Things get good, they want to peel back regulation. What happens when they peel back regulations? The investors think we can take a little bit more risk. And here, I mean, treasury bonds isn't really a risky investment. They just put too much of their damn money in there and wasn't liquid. But that's it. Everybody who had money in there should be getting it. They should be made whole. Those folks who selling things on Esty had a lot of money in SVB, but they should be able to pay y'all when y'all selling y'all goods and services and all of that good stuff. So don't worry about it. I appreciate all y'all tuning in. Y'all have a good evening, morning, afternoon. I say that because I see Aaron in here, and I'm not sure specifically what the time difference is, but y'all have a good evening, morning, afternoon, midnight, whatever it is, wherever y'all at. Y'all take care. Peace.